Hi, everyone. I am Jen Calabrese from Calabrese Consulting, and we are going to be speaking today on the SPAC execution and what actually matters. I'll be moderating the panel, so before we start, though, we'll probably just give a little bit of an introduction on everybody. So again, I am the founder and CEO of Calabrese Consulting, and we provide accounting and financial advisory support to companies. In particular, obviously, with this conference, we do a lot of work on the SPAC side. We currently work with approximately 185 SPACs, helping them with their accounting and financial reporting. We also do a lot of work on the company side or operating company side, where we do IPO readiness, audit prep work, due diligence, so really working with the companies to help them do their listings, whether it's a de-SPAC transaction or a direct listing or IPO. And I'll turn it over to Roger.
Excellent. Good morning, everyone. I'm Roger Salazar, Managing Director and Head of Global Capital Markets at ARC Group Securities. About 15 years in the industry. Prior to ARC, I spent time at both Silicon Valley Bank and Citigroup, having raised over 125 SPACs, closed more than 60 de-SPACs, and raised over $14 billion in PIPE capital.
Hi, everyone. My name is Elena Dunayevsky. I run the SPAC practice at Woodruff Sawyer, now Gallagher. We're the third largest insurance brokerage worldwide, and what I focus on is guiding my clients through a decision around structuring and risk mitigation around their SPACs and de-SPACs, helping them with the directors and officers insurance and other kinds of coverages, and worked with hundreds of SPAC teams, lots of de-SPACs, and it's been about 10 years in this market for me, 7 years on the insurance side. It's been a fascinating run. But before I joined the insurance side of the market, I was a capital markets and securities attorney, which was definitely helpful to my clients because I bring all of that knowledge and expertise to the advice that I offer to them. And I'm delighted to be here. It's, I think, a 7th year in a row, and wonderful to be on this panel.
Hello, my name is Desiree Carlo. I am from Laurel Hill Advisory Group. I head the SPAC department there, where I work on the extension meetings and business combination meetings, manage the redemptions, and work on and help the SPACs with their NASDAQ deliverables. Laurel Hill is proxy solicitation, works on proxy solicitation and shareholder communications. We also do unclaimed property and year-round corporate governance advisory. And so before this, I was a transfer agent for 16 years, and I'm very happy to be here. Thank you.
Hi, I am Caitlin Van Valen. I run sales in the US for Odyssey Trust Company. We are your transfer agent and trust company. So we're the second largest transfer agent and trust for SPACs in the US. It's great to meet everyone.
Good morning, I'm Megan Miller. I'm Vice President of Capital Markets at DFIN, otherwise known as Donnelly Financial Solutions. We provide technology, software, and services to private companies going through the process of either traditional IPOs, de-SPACs, going into the public markets, and we do so primarily through our software Active Disclosure, so both for 33 and 34 Act transaction requirements, as well as our virtual data room venue. I'm thrilled to be here this morning.
All right, great. So I guess, Roger, my first question, I'm going to direct it towards you. Obviously, with the de-SPAC execution, there's a lot of that has to happen, particularly going from a private company to a public company. So in that respect, as a private company, given that they're run very differently, what's the hardest part of that cultural and operational shift for a management team?
Oh, yes, the to be or not to be question.
Yes.
Whether there are pros and cons to being private and public, right? Just like everything in life. You rightfully mentioned there has to be a shift, a cultural shift, a mindset shift. It's not just a systems upgrade, get more fancy accounting tools or more accounting in-house. The way the company operates will be different. they now respond to the public markets. They now have to report earnings on a quarter-to-quarter basis, and that certainly shifts the strategy and the goals. Private companies move fast, they break things quickly, and grow through that. In the public context, there's more scrutiny from public investors, and you have to be aware of that. And that's probably the hardest point of transition from private to public.
Yeah, I find that, just kind of adding a little bit to that, that private companies often don't understand how important it is to really take a look and take a step back to really understand what it means to be a public company. It's no longer running things through your general ledger that you normally wouldn't. You can't put your spa days in there or anything like that. It's a very different environment. And that's something that they really need to really take a look at and take a step back and really assess the importance of it, right? Yeah. Yelena, now, from your perspective, I guess, a correct risk assessment is key to a successful DSPAC, right? So when should teams start working on their insurance and risk mitigation strategies, and what should those look like? Because I'm assuming it's a very important part of the process, right?
Yeah, absolutely. Similar to what Roger just mentioned, going from being a private company into becoming a public company, you are exposing yourself to a great deal of risk, a lot more risk than you had on the private company side. And you really need to consider that, because now you have public shareholders, depending on what your float is, there's going to be a lot of people potentially suing you. If the price goes down or something happens, you're really in the public eye. And so what you really need to think about is the way to mitigate risk. Jen loves it when I say mitigate risk. Inside joke. And the way to do that, there are several ways, right? One would be through corporate governance, good corporate governance that you can build into your structure ahead of time, and your attorneys and other advisors around the room will help you with that. Set up processes around how you do that, training for your employees, things like that. And then the other piece of the puzzle, of course, is the directors and officers coverage. And incredibly important to realize that the policies that you're going to be looking at post-merger are going to be very different from what you've seen prior to. And trying to figure out how to structure those properly in the SPAC environment is incredibly important, because the risks around SPACs are quite substantial. If you look at the numbers that we very closely keep track of on litigation and enforcement and all of those things, the likelihood of getting a securities class action as post-DSPAC is about 16%. And that is higher than what you would see on a traditional IPO company if you're to go public through a traditional IPO, which is around 9 to 10%, and significantly higher than if you were a public company that's a mature public company, 3 years and further out of your IPO. And so you really need to make sure that you can backstop all of the costs that come around as part of that litigation. But you're not able to really figure out how to get that done unless you find that target, right? Yep. So you can't do it at the IPO stage, because you're not supposed to be looking at targets at that time.
No.
And you can, everyone's smiling, they know. And you can't do it a week before a DSPAC, because you're just not able to get everyone in the room together. You need a consensus on both sides, the target and the SPAC, of how you're going to do this going forward. And you also need to give your broker, your insurance broker, hopefully who specializes in this area, enough time to go out there and get the right coverage and pricing for you. So the ideal time around, getting back to your question of when to start working on this, is around the announcement time. So when you find your target, you need to sit down with both teams, figure out who's going to get covered and how, and who's going to be paying for it, right? You don't want to have that discussion a week before the deal closing, because a lot of that will actually end up in your business combination agreement. And so you need to be prepared and have a good base for when you're going forward post the DSPAC.
Yeah. I think that brings up a really good point. I don't know if anybody has a thought on that, but communication is key.
Oh, yeah.
Right? It's not just a matter of, I found a target and that's it. It's really making sure you speak to all of your advisors, surrounding yourself with all of of really good experienced advisors who know the industry, who know the space. A DSPAC is a very, very nuanced type of deal, right? It's not a traditional IPO. There's so many different factors that go into it in different parties. You've got the sponsor side, you've got the target side, and that's not a normal type of relationship or type of structure that you normally see. So I think it's important to have that level of communication with everybody and bring everybody into the room. The bankers, the lawyers, your auditors, everybody really needs to be involved to have that a successful de-SPAC. And like you said, Yelena, to mitigate the risks as much as possible because there's so many things that go into it.
Well, and Jen, to that point, I think it's that flip from the mindset of this is an M&A transaction
Yes.
to this is an IPO.
Yeah.
And what does that mean? Because a lot of the times the teams kind of get stuck on like not thinking about that process.
Yeah.
And so it's no longer a counterparty agreement. It's you in the public market.
Right.
And so that's been one of the things as a transfer agent that we've had to really stick closely to these transactions is getting the teams to rethink that this is no longer like the counterparty between these two companies, and that's how you've been operating as you've gone through due diligence, but you are now really flipping into IPO mode. And that means the broader investor base, that means setting up the infrastructure from the transfer agent perspective, DTC, and then making sure, from the IR perspective that everything's in line for that quote unquote IPO experience.
Yeah.
Yeah.
Yep, that's very true. And going along with that, right, as you're going through the de-SPAC market, the de-SPAC process, and getting all your ducks in a row, obviously redemptions are a very high factor that goes into it as well. But I guess, Desiree, from your perspective, given everything that's happening in the market and stuff, why has the PIPE become such a critical part of getting a de-SPAC done today? What is your thoughts on that?
Like you were saying, high redemptions
Yeah.
are very high, and Doug said even 90 to 95% are redeeming, and high redemptions have changed everything. SPAC shareholders can vote for the business combination, redeem their shares, taking back their money, and what's left in the trust isn't enough to fund the deal. So the PIPE funds step in as replacement capital. But even more importantly than that, it provides validation that institutional investors are willing to commit real dollars. And it signals to the market that they believe the story, the valuation, and the diligence, and that it'll hold up. It tells the street who's backing the deal, at what price, and on what terms. And it provides valuable market credibility. But even taking a step further than that, the PIPE also helps the SPAC meet the minimum listing requirements for the NASDAQ or the New York Stock Exchange, with bringing in more round lot shareholders. So in 2026, the PIPE is more important than ever because it brings not just the replacement funds, credibility to the street, but provides a solution when replacing those redeeming shareholders and helping them get listed on their exchange.
Okay. Yeah. Any other thoughts from anybody on that? Or?
I'll just chime in on the redemption side. I mean, it's wonderful to see Doug was mentioning that there's a few that are now minimal redemptions. That's a really new thing in the market. That's great to see. This question comes up sometimes with my clients when they're asking, what are the ways that we can get into a better situation with our D&O coverage? And it's actually one of the questions that the insurance carriers ask. What is your plan to backstop those redemptions? Are you working on a PIPE? Do you have some other financing lined up? Because obviously, if you're getting into a deal and you've got no funds left at the end of the day, that's going to become a risky proposition. And post the de-SPAC, you're more likely to encounter a lawsuit. So the redemption question comes up at the very beginning, at the IPO stage. So you have to start thinking about it then.
And to add on to that, I think one thing that we always try to walk through, when you're calculating your pro forma, or going through your pro forma, I think it's very important. We've had some sponsor teams calculate redemptions at like 30 to 40%, and they were being very optimistic. And so I think one of the things, and I know Yelena, I think every team here brings this up. It's like, please be conservative when calculating that, because that's going to make a huge difference when it comes to the combination. Yeah.
Yeah.
Just prepare for it. Prepare for
Yeah.
Yeah.
pre-prepare
Yeah.
and have those-
Conservative
Yeah.
and then optimistic.
Yeah. Yeah, exactly. Prepare for the worst, hope for the best.
Yes, yes.
That is very true.
But Jen, I mean, you have an enormous amount of expertise in this space. I mean, you've been in this market. You're somebody that I really look forward to always working with, and you have so much to bring. What are you seeing as the main elements of people getting into the D-SPAC? What should they be focused on from your perspective?
In terms of getting the SPAC, into a SPAC or a D-SPAC?
Into D-SPAC,
Into a
yeah.
D-SPAC, I think really the most important thing is you need to be ready, right? You cannot, as a sponsor, when you're looking at a target and you find a target, there's certain things that you just need to take a look at in terms of the timeline itself, right? Is the target ready to be public? Have they had an audit done? Okay, great. Is the audit a PCAOB audit? That's a separate question, because just because you've had an audit doesn't necessarily mean it was a PCAOB audit, which is what's required. If it's not a PCAOB audit, can your auditors actually do the PCAOB audit? Because if that's not the case, then you've got to go out and hire a whole brand new audit firm to go back and start from scratch to do that audit. All that affects your timeline. So as a sponsor, you really need to be cognizant. You need to talk to the bankers, you need to talk to the lawyers, you need to talk to everybody and say, we found a target, however, this is what we know from a financial reporting perspective, right? And that's how I look at things, from a financial reporting perspective. And then also you need to take a look at the team itself. On the target side, do they have a good financial reporting infrastructure, i.e. a CFO or financial reporting department who understands what it means to be public? Because just because you're going through a D-SPAC, you think that's the hardest part? It's not. The D-SPAC is in essence just the dress rehearsal. Wait till you're a public company, and like Roger was saying before, it's a whole
When the fun
different
starts,
world.
Jen.
That's when the fun starts for everybody else. And you really need to take that into consideration. And again, like I was saying before, it's communication. Surrounding yourself with the right advisors and the right people to get you through that process. I think that is really critical. It's a really critical part.
And one more thing I read about the right advisors. It doesn't only have to be, I think for the process to work incredibly well, it has to be the right advisors, but also the advisors that worked together before.
Yeah.
Because that's when you find the smoothest transaction, because they all know what everyone else needs to get done and when, and that's when it runs like clockwork.
Yeah, knowing who the other advisors are within the advisor world really makes a difference, because you know what they expect, you know what they want, you know how they work and their processes, and that makes a big difference in making sure things go smoothly and efficiently, very quickly, all right? Megan, I guess from your perspective, being ready for a D-SPAC is obviously very critical, right? So how has the definition of deal readiness evolved in today's SPAC and transactional environment? How do you see that?
Yeah, and I think this is kind of in the concept of looking at things from the sponsor side or the target side. And so a target, really, it's not a nice to have, it's a need to have.
Yeah.
To start preparing to act like a public company. Typically, we say, 18 to 24 months in advance of whatever potential transaction you may be evaluating. Most companies, most private companies, are dual track today. They are planning for a sale, an IPO, or potentially a D-SPAC.
Yeah.
And so it is really important that those companies are practicing having a financial reporting process in place. Are you starting to act public while private? Do you have quarterly financials that you are reporting out, just internally, but also externally? So your target, you potentially are looking to raise capital, potentially in the D-SPAC process. So how are you making yourself stand out amongst other companies in that same, in that same perspective? And that's where a tool like Active Disclosure can be really helpful, because a lot of companies at that early private stage may be on QuickBooks. They may just be using Word and Excel to kind of generate financial statements, which can be very manual. It can be error prone. So having a real solution that will help your team to be more effective, not just in the presentation of those financial statements, but also from a risk perspective, and helping you to have a more defined process is really critical. And what's nice about leveraging a tool in advance, you're going to have to start thinking about your ERP system and your overall tech stack. How does that tech stack grow with you from private company requirements into the requirements that you will have during the deal? Financial statements can go stale. How do you keep those current? And then ultimately, how do you go from being a private company into a public company very seamlessly? We always hear the analogy, it's kind of like the wedding and then married life. Those of us, one's really fun and one's can get hard. But being able to kind of get all of the kinks out while you don't have the pressure of the SEC and the public markets that now you are much more visible to is just a really critical part of having a successful public company that now has reporting requirements to the SEC.
This is interesting because we take the angle a lot from the sponsor side, and we're talking about the private target side. And I know that I've actually met with a bunch of private targets here at the conference. That's so important, and I think we had a really interesting, a very large IPO go in January. And one of the feedback that they had was that they started prepping their team about 12 months early to act like a public company. And so they did mock earning calls. And it's interesting now that they're, almost 6 months into the public market, they said that changed everything for their team because they were forced to kind of pretend they were public the year before they actually were. And that prepared the team to understand all the nuances that are going to be involved. So you're not drinking from a fire hose in year one when all the eyes are on you, because that's truly like your first year, it is under a microscope. So if you're a private company and you were looking to potentially go public via a de-SPAC, one of the best pieces of advice that I've heard over the panels over the last 6 months and from a lot of the larger IPOs that have gone public and what you just said is that you start doing mock trials on everything that your financial team, your controller, IR, whoever's going to be handling that public persona starts doing so that you guys are prepared for when that debut actually happens. It's like marriage counseling before you get married.
And I think, Jen, to your point, so you're going to have your team, your internal team, a really great piece of advice as well is if you don't have the existing experience with your team, you may not have someone on the team that has gone through a transaction. There are really wonderful partners and advisors like Jen that you can bring in that can help to kind of fill that gap and help to ensure that you can keep the existing team and maybe give you some guidance relating to hiring, but just to kind of get you from point A to point B more successfully is a really critical part of this as well.
It's so important to have that governance in place
Yep.
so that it is ready post-close.
Yeah. I think, Caitlin, you hit it spot on. Acting like a public company before you're actually public and getting ready. Because that is, if anybody takes anything away from here in terms of a private company wanting to go public, it's try to do it early. Get ready early, because that is going to really, one, it'll make you more marketable to a SPAC, because how many SPACs out there, are looking for a target, and if they see one that's ready, even better. It really does make a difference. And it'll also make you that much more successful when you de-SPAC. So it's key. It really is a really good piece of advice and really good something you really should take away from here.
Yep.
So totally agree with that. I like that answer, Caitlin.
Marriage counseling.
Marriage counseling, exactly. I'm all for marriage counseling. So, Roger, I guess in terms of everything that we've been talking about, and obviously something that's very prevalent and a concern for everybody are redemptions, right? So, in your opinion, how has the redemption environment changed over the past few years, and how has that affected the guidance that you give to sponsors and companies in terms of what to expect and how that's going to work?
Yeah, sure. I've heard scary statistics around redemptions being 90, 95%, which is true in some cases, but I think Doug also cited situations where redemptions were 0 or near 0%. Proudly, I can say that on the de-SPACs I've participated, my average redemption rate has been 30%. So there's something we do right. How do we mitigate the redemptions? What strategy do we use? Firstly, assuring we have committed capital.
Right.
Whether that's a PIPE, whether that's a forward purchase agreement, or any other mechanism, we don't solely rely on the trust. If you rely on the trust, it can be an unpleasant surprise and hope is not a strategy. So what we tell our clients, similar to I think what Caitlin said earlier, is have a conservative case and then be pleasantly surprised and not the inverse.
Yeah, I think that's key. Is you really want to talk to them about what is this plan in case of the redemption. So yeah.
Well, and I think the narrative needs to change, right?
Yeah.
Because a lot of times I think the thought is the redemption volumes is reformation to the deal quality, when in reality it could just be arbitrage.
Right.
And so I think this is one of the biggest things we see from a transfer agent perspective is the lack of understanding of your shareholder base before it's too late. Mm-hmm. If you're in a redemption period and those are coming in, you're too late to shore up the registrar or to have those conversations with the shareholder base. But if we can change that perception, if we can kind of get in front of that prior to redemptions, I think that helps to change the narrative, and maybe we'll at some point bring that number down, because it is very high at this point.
Yeah, it's a very high thing, and I think that's something that really companies really need to understand. And Caitlin, from your perspective, right? I mean, what is it that they misunderstand about how redemptions actually work? Because I don't know if companies really get it.
Well, it's not binary.
Right.
I think that operating companies have it in their head that this is like a very, like, shareholders are either in or out.
Right.
And as we just discussed, like, it's very much a process, right? From the transfer agent's perspective, we are tracking the beneficial holders throughout the process, DTC, and then we're reconciling all the way up through the redemption period.
Right.
And so, like we said, one of the things that I feel like people miss in this redemption period is two things. One, it doesn't necessarily dictate deal quality. You may have had people that are in this deal that want to pull out because it's a low risk, high yield exit. So why wouldn't they? But if you can get in front of that ecosystem prior to the redemption period, it can change the narrative on your registrar base.
Right.
And so that's where I think, prior to the shareholder vote, getting in front of that community will change the narrative around the redemption process.
Yes.
Yeah, I'll add to that. I think the piece that folks miss is the key exercise of the shareholder rotation. As Caitlin alluded to, there may be investors who are there for the IPO and may not accompany you at the DSPAC for a variety of reasons. And the key is, how do you create that orderly shareholder rotation? And it relies around or triangulates to valuation. You have to come up with something that it's sound, that it's not just an agreement between the company and the sponsor, but that also the public market is buying into, and that will help alleviate redemption pressure.
Okay. I mean, and Yelena, I guess really with the whole thing with redemptions and everything that's happening, and I know you alluded to this previously, but in your perspective, right, what kind of risks are modern DSPACs facing? Do you see more regulatory actions? Do you see more litigation? What is it that you're seeing from your perspective?
Yeah, thank you. So the way to think about the risks that are out there, really, I think the easiest way is probably three buckets. One is the enforcement actions and investigations from the regulators. That's one. Number two is the securities class actions. Those are the heavy hitters, really expensive. If you get hit with one, really want to avoid those. Those are federal securities class actions. And the third would be the fiduciary duty suits that we've seen mostly in Delaware. Doug was talking about them as well. All of this is expensive, and those are the three main areas. And so to kind of bring you up to speed of what we're seeing over the last year, we keep very close eye on all of this information because it directly translates to the amount of risk that you're going to encounter, and then directly translates into how much insurance coverage you want to have, right? And from the enforcement perspective, we're not really seeing that much activity. It's not entirely surprising. Doug mentioned this as well. This is a new administration. They're generally more favorable towards SPACs lately. Definitely more favorable than the Gensler administration, and so not really that much activity on the enforcement side over the last year or so, which is great to see. On the securities class actions, there was an uptick in those in the years of 21 to 23, where we saw 30 cases per year, basically going from 0 to 30 really quickly, but that over the last couple of years, it's subsided and it's trending down. So for last year, 15 securities class actions, according to our data. And as of first quarter of this year, 3. So it's definitely on a downtrend, which is good to see. But however, we're seeing a little bit more of an uptick in fiduciary duty cases, and the reason for that is they're easier to bring than the securities class action. So the plaintiff's bar essentially changed its tactics and went into the fiduciary duty cases land. But again, Delaware came out very negative against those, and I know a bunch of people in the room here have experienced it firsthand, but have since changed their tactics a little bit. And so while we're seeing those cases still come to market, it's not as horrific as it was. I have some interesting numbers as to the settlement amounts, because all of these cases, what happens to them? They either get dismissed or they proceed on and you get into a settlement, right? But the interesting part over the last year or so, the dismissal rates for the securities class actions are pretty high. They're about 54%, which is unusual.
Yeah.
So basically, if you end up in that, with that litigation, it doesn't mean that you're actually going to go through the settlement. Likely, it's going to get dismissed. If you do get to settlement for the securities class actions, the median settlement amount is around 9.5 million, and the average is 16.8. So, serious numbers. On the fiduciary duty cases side, the dismissal rate is much lower, 17%, and the median settlement amount is 10 million. So, yeah, pretty significant numbers, which is...
That's a lot of Jimmy Choo shoes.
My goodness. Which is why, you would want to have insurance, because you don't want to be having that amount of money coming out of your balance sheet, right? And you don't want to expose your directors and officers directly to that kind of risk. The other piece of information we're really keeping a close eye on is what's happening in Cayman, right? All of the SPACs in 24 moved to Cayman.
That's right. That's a good point.
Right, to avoid the redemption tax, but also to get out of Delaware. And so everyone continues to ask, and I continue to ask my Cayman colleagues and friends what's happening in Cayman. I just had that discussion with them yesterday again. It doesn't look like there's anything that's very, very concerning that's coming out of Cayman in terms of litigation yet. I'm sure there are going to be some panels later on, and they'll dive into more details. But that's a good thing.
Right.
And then a couple of other things that were very interesting that we saw this year in terms of litigation. One was a dismissal against EY. They actually got brought into a lawsuit. It's unusual for an auditor to get sucked into a SPAC litigation, but it was a class action, it was a fraud action, but they actually got dismissed out of it, so that's a good thing. And then one last one, I think Doug actually mentioned that an insurance carrier didn't want to pay, and the DSPAC sued them. It was one of the multiple carriers on the tower, and that goes to the question of, do these insurance policies actually pay the claims? The answer is absolutely yes. They've been paying millions and millions of dollars in claims. This one decided not to, but the judge said, you know what, no, you can't get out of it. Nice try. So that's a really, really good decision for our clients.
Right. Yeah, I find that interesting, the whole thing about the Cayman thing, because it hadn't really occurred to me. I just felt, that's very interesting to think about that. And I'm sure all of this stuff that's happening affects the premiums. And, I know we kind of touched on this like a while ago, but back when the SPAC boom was happening, the insurance premiums were like ridiculously high. It was just uncontrolled. And now it seems to have kind of, really leveled out a little bit, so I think it's kind of like at a more normal stage, I think now, right?
Yeah, so that reflects several years of seeing how these kinds of enforcement actions and litigation play out. First, the carriers that jumped into this in 21, they weren't really familiar with how this is going to play out, and so they were, hiking up the fees, and the demand was there, so why not?
It was like $1 million plus for
it was
premium
ridiculous.
for a SPAC.
For a $5
it was like
million
crazy.
policy, $1 million in premium. It was horrendous conversations that I had
I
to
felt
have
very
with
bad
my
for you back
clients.
then. I did. I really
it was
did.
bad. It is much better now. We're in the 100, 200,000 range for 5 million policies, so it's definitely a much better environment from that perspective. And so that reflects the fact that they understand what the risk is a lot better, and also the demand and the supply situation in the general D&O market right now. But yeah.
Yeah. So, I mean, we're all talking about, right, the whole DSPAC execution and, assuming that it's going to go through and be successful. But I guess, Desiree, from your perspective, looking back, right, what do failed DSPAC votes have in common? Because that's something that we really haven't touched on. I don't know if anybody really has talked about on any of the panels.
I think we can combine failed DSPAC votes in the business combination along with when, say, it passes the business combination, but it doesn't get to close.
Right.
So I think they all have the same warning signs, and it touches on what you say, Caitlin, not getting in front of it. The SPAC not communicating and talking to the shareholders and doing everything that they have to do to prevent the redemptions. So they all have very much the same warning signs. Extremely high redemptions, signals to the market that the shareholders and the market just aren't buying this story. And the shareholders don't understand or they don't trust the projections, the valuations, or the post-close governance. The sponsor incentives seem misaligned, and trust breaks down, and the communication seems more reactive and not credible. In almost every case, it's not just one fatal issue, it's just a breakdown of the trust and confidence. Once investors start not trusting the economics, the post-close governance, or the transparency, momentum turns quickly, and it becomes a vote or it becomes based on trust and not on the transaction itself. And and it fails and it breaks down.
I think everyone's goal here, especially, and this is a small ecosystem.
Yeah.
Like, you are going to find that the people who operate within the SPAC ecosystem pretty much all know each other.
Yeah.
And have all worked together, probably on multiple deals. Yeah. And I think everyone's goal is to continue to, one, grow this product, but also legitimize it.
Yeah.
Well, how do we do that? We get more DSPACs, right? We get more successful DSPACs. And so if we can continue to open up the narrative to what hasn't worked and how can we prevent it moving forward, then we are going to land at more successful DSPAC transactions. And so I think if you were to take anything away from this panel, it's if you feel like this is going easily for you, you're doing something wrong. Because it's not. It's a very cumbersome process. It's extremely nuanced. It's not your job to know what questions to ask. It's our job to tell you what to be looking for. And so when you pick your deal team, you're looking at pretty much, I mean, we're missing a lawyer, I guess. But you're looking at the team that you need, plus a lawyer and the banker. Well, we got a banker.
No.
Sorry.
Hey,
token banker.
hey.
We got a great banker. He's sitting a few seats down from me. But truly, ask the questions. Or be up front and say, I don't know what questions to ask. What do I need to be looking out for? Because we're going to be here. We're going to be the teams that say, these are the things you need to be looking out for so that you can get to that successful DSPAC transition, and then to have a long-term publicly listed company where then you're with me forever as transfer agent.
Right.
So
Trust your advisors, I think, is
Trust
really
your advisors.
important, because that's exactly what you're saying. Surround yourself with advisors who know, but trust them. Again, we're here to get you across the finish line because we all want you to be successful because we all want to get paid, so not for nothing. But at the same time, we've been in this ecosystem for years and years. We know it, forwards, backwards, inside and out, up and down. So ask the questions, trust your advisors, listen to them. Not that you have to do what they're telling you, because you at the end of the day, it's your transaction, so it's up to you. but listen to what they say, because oftentimes if you ask the same question to each of your advisors, we'll probably all come back with the same answer. So definitely just do that. But along those lines, right, Megan, what I'm thinking is, we have all these companies, right, and they're all trying to do a de-SPAC. But what are the consequences for companies that enter into a transaction without really good institutional grade financial systems and controls in place? What's going to happen?
The major difference is whatever scrutiny was not there while private is now there, because you have a stock price, you now have investors that you have to be responsible to. And so to me, it's really kind of getting all of the things and getting the practice out of the way while you're private, while you have time on your side, because there is no forgiveness when you are reporting publicly. And there is so much that you can do because everybody has a day job. So the transaction is the transaction, but you still have things that you're trying to do to grow, to fundraise, to tell your story, to have all of the conversations that you're having in advance of your transaction. Once you become public and you have to start filing, the consequences are real. You don't want to have any delays in your filing process that has impacts for your ongoing status as a public company.
The SEC is not forgiving. They don't care that you have a vacation planned.
Right. That's true. Yeah, exactly. So it's kind of getting things out of the way and getting the practice out of the way, so when it is time for you to shine, you can do that and continue to put all of the hard work into continuing to create value for your shareholders.
Yeah, all right. Well, great. Well, that is it for us. Oh, you have a question. You can ask a question.
Or fund it? And how do you mitigate the redemptions? Because if you have a high amount of redemptions, somebody didn't know what they were doing.
Yeah, I can take a stab at it. So I think the question was around how do you mitigate redemptions, and what happened? Why does it fail? Why does it end up that way? Well, first of all, what IPOs in the SPAC is the team. And so it has to be the right team that has proprietary deal flow, that has a track record in deal making, and they are supported by your IPO investor base, which could be a variety of investors, and it's best if you can bring investors from your prior lives and support that transaction, right, the IPO. And then you have to rotate the shareholder base for your de-SPAC, fill it with sector experts, long-term holders, fundamental holders, and as a mitigant to the risk of the redemption, if that shareholder rotation doesn't play out as planned, raising committed capital, right? And how do you raise committed capital and entice investors to come into your pipe at? You would ideally want $10 a common, striking, first of all, presenting a great company, and second of all, striking at a valuation that's reasonable to the public markets.
Okay. All right. Well, thank you, everyone. And that's it. Thank you.